Hi everyone! In this video I would like to tell you about a new DeFi project called Swivel Finance. As Swivel Finance calls itself, it is a protocol for fixed yield lending and tokenized cash flows. What does it mean exactly? Well, in more simple terms, it means that you can deposit an asset for a fixed rate interest and trade the yield generated by that asset. It is possible because your deposit is split into two separate tokens. One represents your initial deposit, while the second represents the future yield of that deposit. Yield tokens are unlocked right from the moment of depositing an interest-bearing asset into the protocol, and you can immediately sell them to lock in the fixed yield. Before we dive deeper into the specific technical realization of this concept in the Swivel protocol, I would like to set a stage and make a brief overview of how lending works in DeFi currently and what problems it poses. After that, we'll look more closely at the Swivel protocol. We'll discuss its core architecture and highlight its main features. Finally, we'll try some of the functionality of the protocol ourselves. Let's assume you want to earn interest on your crypto by lending it to other users in a decentralized manner. Today, what you normally do in this situation is you supply an asset to one of the money market protocols like Compound and receive back a fixed amount of interest-bearing tokens, called nTokens. These tokens represent your deposit plus interest. nTokens start accumulating interest right after the protocol issues them to you, and they are necessary to redeem your underlying asset from Compound at a future date. When you want to redeem your deposit, you send the protocol your nTokens, and the protocol sends you back your underlying asset with any interest accumulated for the respective period. Although you can redeem the underlying asset at any time, you can never know how much you will earn from it, because the interest is variable and determined by the ratio of supplied and borrowed capital in the respective money market. You have no certainty about your earnings. Upon depositing, you may be exposed to 10% APY, which can easily become 5% next day. Variable interest rates are not suitable for regular users and institutional players. They both want predictability. Moreover, this system is capital inefficient. You lock your asset into a protocol and cannot use it elsewhere until redemption. These two problems together constitute a major flaw of the current DeFi lending and prevent its more widespread use. Swivel protocol aims to solve both of these problems by building a decentralized platform where you can lend for a fixed rate and trade the yield generated by your deposit. Swivel Finance builds upon the current lending mechanisms in DeFi and aims to create a democratized infrastructure necessary to enable high fixed rates without sacrificing decentralization, capital efficiency, or transaction costs. To achieve this goal, Swivel introduces a two-token model. Unlike what happens in protocols like Aave or Compound, where you receive one yield-bearing token in return for your deposit, in Swivel, your deposit is split into two separate cash flows, called ZC tokens and nTokens. For example, if you deposit USDC into the Swivel protocol, it is split into two separate component tokens, ZC-USDC and nUSDC. The amount of each of these tokens is equivalent to your initial deposit. ZC tokens represent the claim to your initial deposit and can be redeemed at a 1-to-1 rate for your deposited tokens at maturity. In contrast, nTokens represent the claim to any yield generated by your deposit, and this yield can be redeemed at any time. ZC tokens and nTokens together represent full ownership of the underlying asset. Their prices are reverse dependent. Specifically, ZC tokens are discounted at a rate based on the predicted future yield generated by nTokens. They are priced below par and appreciate towards it as the market gets closer to maturity. In contrast, nTokens are depreciating assets. They decrease in value as the market gets closer to maturity and become worthless once the maturity is reached. Swivel Finance provides an infrastructure to facilitate the participation of market participants. Swivel Exchange. Swivel Exchange is an orderbook-based exchange built on top of the Swivel protocol. Until maturity, users can trade ZC tokens and nTokens to enter and exit positions based on their expectations regarding future interest rates. Let's consider how it's done in the case of nTokens. Imagine Alice, who has 1000 USDC and wants to get some yield by lending it. She's pretty satisfied with the current interest rate, which is, let's assume, 5%, and believes that it is likely to drop in the future. What she does in such a case is she splits her asset into ZC USDC and nUSDC, and then immediately sells her nUSDC to lock in the yield. How much will Alice actually earn from this? To answer this question, we need to find out the price of 1000 nUSDC in this case. As nTokens represent the right to receive the yield generated by the underlying asset, then if the current interest rate is 5% and it is 12 months until maturity, the price per 1 nUSDC will be 0.05 USDC. Therefore, after selling her nUSDC, Alice will receive 50 USDC. In the end, Alice is left with 1000 ZUSDC, which she can redeem for the underlying 1000 USDC at maturity, and a secured yield of 50 USDC. Now imagine Bob, who instead believes that the interest rate is actually going to be higher in the future. He wants to bet on this belief and buys 1000 nUSDC from Alice, paying her 50 USDC. This gives him exposure to any yield generated by Alice's initial deposit, which he can then redeem at any time he wants in the future. This is great from the perspective of capital efficiency. Assuming that the rate will stay at approximately the same level throughout the entire period, Bob will receive 5% of 1000 USDC, instead of 5% of 50 USDC he would have otherwise received by lending his deposit directly on Compound. I should also say that Swivel Finance is not the only protocol that implements a two-token model to enable fixed yields. There are other protocols on the market that are based on the same mechanism. However, Swivel differs from other protocols in that it uses an order book instead of an automated market maker. This improves capital efficiency a lot. Specifically, with an order book, there is no need to create separate markets to trade ZC tokens and nTokens. They are traded on the same market and share the same pool of liquidity. Moreover, users can place gas-free limit orders and move their positions with no cost to accommodate the change in the rate. Liquidity providers on an automated market maker are simply not able to do this efficiently. I should also say that this is just a very basic picture. For a more detailed discussion of Swivel's competitive advantages with respect to other fixed yield protocols, I refer you to the articles published by the Swivel team. Links will be provided in the description to this video. In the last part of this video, I suggest that we'll look at Swivel in action. I will demonstrate how you can realize the above described strategies yourself. To demonstrate the functionality of Swivel Exchange, we'll be using its testnet run on the Rinkeby network. It means that to use the app, we first need some test ETH to pay for transactions commission. There is a great faucet developed by Chainlink, where you can get yourself some ETH in just a few clicks. We need to insert our address, pass a capture, and then just wait until ETH is deposited to our wallet. Usually it takes no more than a few seconds. Here we go. Now we can go to the Swivel Exchange. The second thing we need to do is to faucet an asset we will lend. For that we need to go to the Professional page and click on the Balances box. Here we see a faucet where we can get up to 100 DAI. Also note that not every DAI will do the trick. At the moment, Swivel is integrated with Compound, and you will need Compound's DAI. The most straightforward way to get it is directly via Swivel's interface. Yep, now we are fully equipped to access the protocol. As you have already seen, there are several pages available. The main one with a simplified interface. The professional page with a more advanced interface and extended functionality. And there is also the positions page. This is the page where you can track your balances, claim interest generated by holding nTokens, and, most importantly, deposit your asset and split it into ZC tokens and nTokens. I suggest that we do just this. Sign in the necessary transactions, just need to wait for a few seconds. Yes, and now you can see that we are left with equivalent amounts of nDAI and ZCDAI. And now we can click on Trade to enter or exit positions on the exchange. When we click on Trade, it will get us to the professional page. Here you see that the interface is pretty similar to the one you find on a usual exchange. You see an order book and a chart. You can also choose a market, but instead of having a pair of assets, you have an asset and info about this market's maturity. You can also choose which asset you want to trade in the balances box. In our case, it can be DAI or one of the underlying tokens. To lock in a fixed yield, you need to select nDAI. Then you can choose the amount of tokens you would like to trade. After that, you will see how much premium you will get, which is determined by the price per nToken. In our case, it is 3 DAI. This price is determined by what people are willing to pay for nDAI at the moment. So let's click on Place Market Order. Also note that you can just as well place limit orders if you are not satisfied with the current price. So, we've just earned approximately 3 DAI and now only have ZC DAI. What's great is that you can actually do the same interaction in just a few clicks. For that you need to go to the professional page or to the main page. Choose DAI, choose Fixed Yield, and select the amount you want to lend. After that you will see the amount of premium you will receive for lending your asset, the price per nDAI, and the estimated APY, which is based on the current price of nDAI. As you see, the interest yielded is not really 10.9 of 30 DAI. And actually it's right, because the market has already been live for some time and there is not a full year left. So the yield is less than that for the full year. Now we click Place Market Order, approving the transaction, and here we go. We've just landed for a fixed yield. If you want to get an amplified yield and purchase nDAI for DAI, you just need to click this button. Select the amount of DAI you want to spend on nDAI and click Place Market Order. As you see, the APY is negative. Do not take it seriously. It's just because the users on testnet spend monopoly money, and they are ready to pay higher rates than those actually present on Compound. It will not be the case on mainnet. As you see, we ended up with 54 nDAI. If you want to exit your positions before maturity and redeem your DAI early, you can go to the Positions page and click the Combine button. Here you need to insert the amount you would like to spend, click Confirm, sign the transaction, And this is it. Also note that to redeem your DAI before maturity, you will need to spend equivalent amounts of ZC DAI and nDAI. This is in contrast to when the maturity is already reached and you only need ZC DAI to redeem your underlying asset. Well, that's basically it. As you saw yourself, the design is clear and the experience is smooth. In the end, I just want to add that you can follow Swivel's social nets to stay tuned for any upcoming announcements. And in particular, I encourage you to join Swivel's Discord server, where the main activity goes on. Among other things, there you can leave feedback regarding your personal experience with using Swivel protocol. Thanks for watching.